Hello, welcome back to this week's market update. Today is Monday, April 15th, 2024, and we had a very full week of economic data, so we will jump right in. Last week, stocks finished lower for a second week in a row as hotter than expected inflationary data worried markets with the CPI on Wednesday. As of Friday, March 12th, the Nasdaq Composite fell about 0.5%. The Barclays Aggregate Bond Index fell 0.65%. The S&P 500 down 1.5%, and the Dow Jones Industrial Average down 2.3% for last week. And a lot of this had to do with the hotter than expected inflationary data and some geopolitical tensions as we ended out the week. To start off our week, the March CPI was by far the biggest surprise, the biggest driver of markets last week. So we saw headline inflation tick up to 3.5% in the month of March, which was much higher than February's 3.2%. It also marked the highest inflation rate in 6 months, so that was quite notable there as well. On the other hand, we saw core CPI just flat compared to February's annual rate at an annual inflation rate of 3.8%. And then on a monthly basis, both headline and core CPI were up 0.4% from February. Looking at what drove this really hot inflationary reading in the month of March, leading to this 3.5% inflation rate, we saw food inflation moderate at 2.2% from a year ago, groceries up only 1.2% from a year ago, which is quite positive for consumers at the grocery stores. Then going through here as well, energy was up 2.1% from a year ago, up 1.1% in just 1 month, so that's quite notable there. We also saw things like the used cars and trucks category slip from a year ago. And then the biggest driver of inflationary pressures in terms of the greatest annual increase was transportation services. So transportation services up 10.7% in cost from a year ago across the category, and auto insurance alone was up more than 22% from a year ago. So overall, you can see just kind of interesting segments of how the BLS breaks this down. Certain things like food and energy have seen more moderate inflation, closer to that 2% rate, whereas other things like shelter still showing a 5.7% inflation rate, and transportation services up over 10% still. So, what does all of that mean? What does the hotter than expected CPI report actually mean for consumers, for economists, for markets? And when we look at the target rate probabilities for the July Fed meeting, we can see some pretty interesting things of how expectations have shifted quite a bit over the last month. So, here looking at the chance that rates stay exactly where they are here in this range. A month ago, there was a very low chance, just above 10%, that we were going to see rates stay where they are through the July Fed meeting. Now looking at this, you can see there's a above 40% chance that we will see rates stay the same through July, meaning that the Fed wouldn't cut rates until September. So that's quite notable there. And then also over here, you can see that a month ago, markets thought there was a pretty decent chance that we would see 2 rate cuts by the July meeting, and now there is a very low chance of that. So lots of moving pieces, very dynamic market, but want to keep on track with some of these economic data points as they will give us some great insights of where the market may be heading. Also, with the consumer price index, we also get the producer price index, which gives us a good idea of the inflationary pressures that businesses have been feeling. And looking at the PPI here for the month of March, headline inflation was at 2.1%, while core inflation was at 2.8%. So both were a little bit of an increase from the previous month's inflation rates on an annual basis. And in fact, the headline PPI rate is the highest since April of 2023. So not great on that front, although when you do put it in perspective, 2.1% inflation is quite moderate. Then on a monthly basis, that amounts to a 0.2% increase in prices month over month in both headline and core PPI there. Then breaking it down even further into goods versus services, goods actually fell 0.1% month over month, while services increased by 0.3% month over month. And that was led by a very heavy increase in transportation and warehousing costs, just like how we saw in the CPI there. So, some interesting stuff there, a little uptick in the PPI in accordance with the CPI. Moving along through our week, on top of some really important inflationary data, we also got some important consumer sentiment data, which also has to do with inflation. We saw consumer sentiment ultimately decline 1.9% in the month of April, month over month. However, this was largely attributable to rising inflation expectations. We saw the inflation expectations for a year ahead increase from 2.9 to 3.1% in annual inflation expected in the year ahead. And then we also saw longer term inflation expectations go from 2.8% to 3%, which is actually pretty close to what the CPI has historically been over the last 100 years, but it is notable that both the near term and the long term expectations of inflation ticked up at the same time that we saw real data show that inflation was running hotter than expected. So consumers are kind of feeling these inflationary pressures and they are revising their expectations of inflation upwards. One final update from last week as we kicked off the start to Q1 earnings season, we had the big bank earnings on Friday. So JP Morgan ultimately was better than expected earnings, but their guidance looking forward was pretty weak, ultimately leading the stock to drop about 7% on Friday on the news. And then their CEO, Jamie Dimon, he had some serious caution about economic risks and geopolitical risks ahead as the bank looks forward both on a macro level and on a company specific level. Looking at Wells Fargo, that was better than expected as well, but their net interest income, which is the spread they make between what they pay depositors versus what they loan out, the interest difference on that, that fell 8% from a year ago. And then we saw Citibank also better than expected, and their layoffs that they've been restructuring, those are pretty much done, but there have been some hefty costs, some hefty severances and costs associated with those. Finally, we had BlackRock. They also beat expectations and they recorded a 10.5 trillion record assets under management, which is quite remarkable to think about that number. And then one final trend that I think we're going to see in some more bank earnings, over 100 banks have been issued these FDIC charges, these special assessments, they call them, from the regional bank failures last year. So it's a very small percentage. You can see very, very small, 3.36 bips of their uninsured deposits for certain banks that have over 5 billion in assets. They have been assessed this special fee starting this quarter, and it's going to go up to 8 quarters moving forward until the FDIC kind of makes up for some of the money that they lost with the regional bank failures last year. So it was a very busy week. We had a lot of important data going on last week, a lot of geopolitical updates, and earnings season kicked off. So we will continue to monitor the portfolios, and we thank you so much for tuning in this week. Looking forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.